Welcome to Oraculum Accounting, Taxation Fundamentals and Return Filing. This module explains how taxation systems operate and how tax returns are prepared and filed. It focuses on determining taxable income, following correct procedures, and ensuring accuracy through reconciliation, documentation, and ethical compliance. Purpose and principles of taxation. Taxation exists to generate public revenue and support economic and social objectives, such as income redistribution, regulation of consumption, and market stabilization. Tax systems are guided by key principles. Equity ensures taxpayers contribute based on capacity. Certainty ensures obligations are clear and predictable. Convenience ensures taxes are collected in a manageable way. Efficiency ensures administration costs remain proportionate to revenue. Who prepares a tax return? Tax returns may be prepared by individuals, professional accountants, or internal finance teams depending on the size and complexity of the taxpayer. Individuals and small businesses often prepare their own returns using financial records. Many engage professional tax practitioners to ensure compliance. Larger organizations rely on internal tax departments with oversight from external advisors. Types of taxes: direct versus indirect. Taxes are classified based on who bears the burden. Direct taxes are imposed on income, profits, or wealth, and cannot be transferred. Indirect taxes are applied to goods and services and are embedded in prices, allowing the burden to be passed to consumers. Tax return filing form. Parts and components. A tax return form is a structured document used to report income, deductions, and tax liability. It includes identification details, income reporting, deductions and adjustments, tax computation, credits, final tax position, and declaration. Each section ensures that the tax authority can verify accuracy and determine liability. Taxpayer Identification Section. This section captures identifying details such as name, tax identification number, address, and reporting period. Income or Revenue Section. This section records all taxable income including business income, salary, investment income, and other receipts. Deduction and Adjustment Section. This section includes allowable expenses, depreciation, exemptions, and prior losses permitted under tax law. Tax Computation Section. This section calculates taxable income and applies relevant tax rates to determine gross liability. Credit and Prepayment Section. This section accounts for advance tax payments, withholding taxes, and eligible credits. Net Tax Position Section. This section determines whether tax is payable, refundable, or balanced. Declaration and Authorization Section. This section confirms accuracy through signature, date, and certification where required. Net tax payable versus other outcomes. A tax return determines the final liability after adjusting for payments and credits. The outcome may be additional tax payable, a refund due to excess payments, or a nil balance where obligations are fully met. Taxation of businesses not registered for GST. Businesses not registered for GST cannot charge GST or claim input credits. GST paid on purchases becomes part of cost. However, they remain liable for income tax and other indirect taxes embedded in prices. Relationship between financial statements and tax filing. Financial statements provide the foundation for tax computation. Accounting profit is adjusted according to tax law to arrive at taxable income. Reconciliation ensures consistency between financial reporting and tax compliance. Tax reconciliation. Tax reconciliation explains the difference between accounting profit and taxable income. It involves adding non-deductible expenses, deducting allowable adjustments, and accounting for timing differences to derive final taxable income. Example of tax reconciliation. An accounting profit is adjusted by adding disallowed expenses and deducting allowable tax benefits to determine taxable income. The final tax liability is calculated on this adjusted figure rather than accounting profit. Tax return outcome scenarios. A tax return may result in additional tax payable, a refund due to excess payments, a nil balance, or a loss position where no tax is payable, but losses may be carried forward. Scenario: sole proprietorship. Business income is treated as personal income of the owner. Tax is calculated on total income after deducting allowable expenses. Scenario: partnership. Business profit is calculated at the partnership level and allocated to partners. Each partner pays tax individually on their share. Scenario: trust. Income is managed by a trustee and distributed to beneficiaries. Tax is generally paid by beneficiaries, while undistributed income may be taxed at the trust level. Scenario: company. A company is taxed as a separate legal entity. Profit is adjusted to determine taxable income and taxed at corporate rates. Shareholders are taxed separately on dividends where applicable. Role of a tax return preparer and ethical responsibilities. The preparer ensures accuracy, applies tax law correctly, maintains confidentiality, and avoids misrepresentation. Ethical conduct is essential as tax returns are legal declarations. Relationship between tax filing and auditing. Tax filing relies on financial data, while auditing verifies its accuracy. Together, they ensure compliance, transparency, and reliability of financial reporting. Conclusion: taxation is a structured process that integrates accounting, legal compliance, and ethical responsibility. Understanding its principles and procedures ensures accurate reporting and effective decision-making. Thank you for watching. Subscribe for more informative content.